Online?
Hello, hello.
Yeah, online. Okay, guys, let me introduce a friend of mine from Silicon Valley, Vitaly.
Last time we did this in Russian, but I grew up in Bay Area since I was 8 years old and certainly got all my education in English. And since we're going to be diving into some technical questions, I think English is better and I think everybody will understand us just fine. So over to you.
Yeah, okay. Introduce yourself.
So my name is Vitaly Golomb. I'm a investment banker currently. I've worn a lot of hats. I run a small boutique firm called GS Capital. We do capital raise, M&A, and corporate venture advisory for companies all over the world. We have a particular focus on transportation and mobility. Worked with great companies like Rimac, Fisker that just recently announced their SPAC and going public. Hyperloop Transportation Technologies is one of our clients, and a number of others. So we focus on the sector. I have my opinions. I think we're going to dig into Tesla's earnings a little bit and talk, try to interpret that a little bit. One disclaimer, this is not investment advice. I am a registered broker-dealer. I'm expressing my opinions. If you're interested in any of these stocks, talk to your investment advisors. Don't take it from webcasts, certainly. This is not Robinhood here.
Okay,
so
what's going on with
that's
Tesla?
What's
Sorry.
that?
Yeah, what's going on with Tesla?
So Tesla announced their earnings, fourth quarter of consecutive profit that they've shown. And I've had issues with the company primarily because, well, let's start with the good. The good news is that Tesla has done something that nobody else was willing to do, which is really do a kamikaze mission of make electric vehicles mainstream. And that's a great thing for the world, for the planet, but certainly not something you're going to expect out of the Germans, out of the Volkswagen Group or Mercedes. They're not in the business of losing money, and they weren't willing to make the investments early on to really kickstart this revolution. Tesla was, and good for them. However, the main problem with Tesla is that you have, in some ways, a genius CEO, who, by the way, was not the founder of the company, that a lot of people credit him with. He tends to say a lot of controversial, stupid things on Twitter, much like another leader we know. And the company is very overvalued. So you can see that this is a retail brand, especially during a pandemic when you have a lot of retail investors gambling on Robinhood because they can't go to Las Vegas. A lot of it is putting it into the company, the only brands that they know. So Tesla is a famous brand and you get a lot of attention. Same thing happens with all of the other big tech brands because they are a bit overbought in the sense that they comprise something like almost a quarter. Top 10 stocks comprise almost a quarter of the market cap for the public markets. So that's a little problematic because if there's a little correction in the tech sector, that means that the entire market's going to dump pretty heavily. But Tesla is particularly interesting in the valuation sense. I just looked up the book value of Tesla versus Toyota versus Volkswagen, Toyota and Volkswagen being the true biggest companies in automotive in the world based on number of cars that they sell, which is over 10 million each per year. And for those that didn't do finance in college, what book value is really, I'll give you the technical definition. It's the total assets minus liabilities, preferred stock, and intangible assets. In other words, this is what the company is truly worth. And you look at the ratio of the market cap, all the stock, outstanding stock times the stock price, that's the market cap, versus the book value, and you can kind of compare the sectors, right? So the sectors will typically trade somewhere within that range, and all of the car companies are basically trading somewhere between 0.5 book value to market cap to maybe 1, right? 1 to 1. Tesla, I just looked it up, as of today's stock price is trading at 29.4. So you can argue that if Tesla is a car company, and I argue that Tesla is a car company because that's the product they sell, they are overvalued by 30x compared to their peers in the industry. So
Yeah,
why,
revenue.
certainly Tesla
Yeah.
deserves a premium, but a 30x premium, I don't think so. The book value, the price to book value ratio like this is assigned to high growth software companies, because those software companies, they have really high margins, right? Car
Yeah.
companies have really shitty margins. It is not a good business. Manufacturing is expensive, has high capex, high opex. You are at the whim of any speed bump in the economy. You have huge expenses, fixed expenses, and people argue that Tesla is a software company, but that's nonsense, because they're not a new company. They're not a startup. They've been around for 15 years. They've been public for much of that. And by the way, this quarter, everybody's celebrating how wonderfully Tesla did. They actually had a 5% drop in number of cars that they sold, even though they opened up their Beijing factory, a completely new market. They're heavier into Europe and all these things. They have a huge drop. And in the US, the drop is even bigger. Like if you look year to year. So I want to say that it's really overvalued. Then, of course, people are going to come out and say that autonomy is the answer, and I have an answer to you on that. Tesla now charges something like $8,000 for the full autonomy option. And I was on a call yesterday with a bunch of autonomy industry experts. And by the way, my firm, we wrote the biggest industry research report last year on electric and autonomous vehicles. You can get at gscap.co/reports. And we're doing an update right now for 2020. Pretty much everything that we saw happening stayed the same. And the biggest driver is government subsidies in electric vehicles. But with autonomy, on that call, there was a quick survey of all the experts, and we're talking about somebody part of the founding team of Zoox, CTO of Luminar, which is one of the top LiDAR companies, and a few others. And the expectation of full autonomy is somewhere between 8 and 16 years from now, right? It's not a million self-driving cars in a year. That's all nonsense, absolute nonsense. That's not going to happen. I promise you that right now, right here. So, Tesla, it's a little bit fraudulent, I would say, is the word I would use, because they very well know this. And anyway, so that's my quick 5-10 minutes on Tesla. Big fan of electric cars. I have a couple of deposits on cars I'm excited about. I've helped companies in this space for a long time, and I'm very bullish on electric vehicles and future vehicles. But Tesla is not looking like real world. Let's put it that way. So
Okay.
I'll end there.
What is you like the insights if we talk about Telegram and SAC? What's going on?
So Telegram and SEC, I haven't been paying attention as closely as probably others, but I mean the general thing is that the CEO, he likes to complain a lot. He likes to take advantage of of anything that he can find in the market to build a business, which is great. But then he needs to play by the same rules, and SEC slapped them down and basically made them refund all of the capital that they raised through their illegal capital raise, because they didn't follow the rules. So why does SEC exist? Why do these rules exist? Let's start with the basics from investment banking perspective. These rules are not big bad government. These rules are designed and were largely put in place after the Great Depression, after the stock market crash of 29, to protect retail investors. That means that you have certain standards of how information is given out, what kind of investors are able to buy certain things. And it's very simple. It's SEC's entire charter is to protect retail investors. So they've set up certain rules that have been running for 90 years or so, since the Act of 33 and 34. And if you're going to sell securities or anything that resembles securities, you need to follow those rules and basically have full disclosure that's normalized. So you're not tricking or fooling anyone. And Telegram didn't want to follow that. They wanted to be creative. I always say, like, be creative with the technology, but don't try to reinvent the financial markets that existed well before you. So I think that was well overdue, and it was good that SEC actually moved on that, because that's a cautionary tale for others. It's not that difficult to do a proper capital raise and follow the rules. If you want access to U.S. capital markets, you need to follow U.S. Financial industry and securities industry laws and rules. Same thing with every other area that you're going into. So if you're going to UK or Singapore or anywhere else, they've set up rules and you follow their rules, because their job is to protect their citizens.
Mm-hmm. Great. And next question, what do you think about TikTok and what's happening with privacy? And it's looked like the special relationship with China government. And by the way, they have more than 60% of the investors. This is investors from US market as well.
Yeah. So ByteDance, the parent company, has a couple of different products. One is TikTok. The other is a very popular product for news media in China. And the argument, in short, is that that TikTok is collecting a lot of data, which is true. It's collecting a huge amount of data, just like many other social networks do, but this one in particular. And it gives you this kind of viral content, and has really good predictive algorithms to know what you're going to like. And people are actually spending more time in TikTok than Instagram these days. That's the last I heard. And the fear is that because this is a Chinese company, the Chinese government can come along and ask for that data at any point, or get access to it through a backdoor. The original funders, like Sequoia China, I think, funded the company as well. So there's a lot of interest, Sand Hill Road interest in this company, and it's doing phenomenally well. And the parent company, I think, is officially the most valuable private company right now, something like 90 billion valuation in secondary markets. And what's happening is that now it's a political football, because President Trump wants to blame all his problems on China. So he's looking for big tech players that he can ban, because that's relatively easy. So TikTok has hired a American CEO who was part of Disney Plus, the streaming service. And it looks like they want to do a carve out. I keep reading more and more about it. They keep leaking. I'm not involved with the transaction anyway, but I keep reading about it, that they want to spin it out, and they want to make it a separate U.S. company or independent company altogether, somewhere in offshore, and take it public on the U.S. market. So it's going to be interesting to watch, but that's certainly a political football. I think yesterday, U.S. government forced Chinese consulate in Houston to close. So it's a little bit, it's escalating, the situation between U.S. and China. That's not a good thing. We have lots of friends there. I mean, certainly it's a communist country, and you need to understand that that means something. That companies can't operate freely entirely. But there is a way to work within that system. So anyway, that's my piece on TikTok.
Yeah, okay, let's move to our time about trends for the next 5 years after the crisis.
The what?
It should be like mostly maybe machine learning, maybe something new in digital healthcare, maybe like something new in energy, green energy, and education as well. What is you like the
So let's touch education first, and clean energy, and then kind of the overall trend that I see. Education is going through a big transformation. What has COVID done? I think we talked about it last time. COVID is an accelerator. It didn't create much new. It just accelerated trends already happening. So distance learning was not invented in the last 6 months. But it's becoming much more important, because it's becoming the only choice in a lot of cases. So in the US, big arguments, it's very unlikely that schools are going to reopen in the US in August, September. So what to do? I mean, I can tell you with my kids that are 10 and 12, they were finishing 4th and 6th grade last year. And those last 3 months were a complete waste of time, because the teachers were not prepared to do this remote learning. And it was something like, I don't know, half an hour Zoom every other day. And like, here's a reading list. I mean, it's nonsense. So now they're probably more prepared for the fall, but still, this is an issue. So I'm trying to plan ahead, and we're already supplementing with Khan Academy example. And I actually was talking with a friend of mine, recorded my podcast last night with her. She's in Thailand and she's doing the same thing. So they have a small school. She has twins and they have a small school. So she has 6 kids in her living room every day, with a teacher, and they're supplementing with a lot of online materials. So that's going to be interesting to see. I think grade school is one thing, but colleges have a profound problem because a lot of students don't want to return to campus and shouldn't return to campus. And then there's this whole thing with international students.
They should not.
I don't think they should. Well, I mean, nobody thinks they should because there's no way really. I mean, you remember college, like what people are going to social distance in college. The whole point of college is to not socially distance. So I think in a lot of cases, there's a big enough percentage of students that are taking a gap year to kind of see what happens in a year. There are some schools that are doing online learning, distance learning. It's a challenge. And Scott Galloway has a lot on this that he talks about. He's a professor at New York Stern Business School. And talks about kind of, when you're talking about the Harvards and the Stanfords of the world, they have a huge waiting list. And maybe if they have a lot of people fall off, they'll still be able to get enough students to fill up whatever way they are planning to provide instruction this year. But then when you start going to like second or third tier schools, they don't have waiting lists. They're going to be like half empty, and they're not running on big margins, right? This is not a software business. They're paying professors a lot. A lot of them are tenured, means that they have their job for life. And they're going, a lot of colleges are going to go under. So this is a big problem. On the other hand, you're going to have this interesting phenomenon where you have, instead of 1-star professor teaching a class of 30 students at a small private college, you're going to have this 1-star professor teaching 30,000 students online. So that from that perspective, that knowledge is going to get out there, which is interesting. But the teaching mode is going to change. So that's on education. It's quite a challenge. But I think right now we're dealing with this pandemic. Let's say in a year, hopefully, things are closer to quote unquote back to normal. I think still we're going to have these long-term trends in education with online learning, which is okay because adaptive learning is actually much more effective than everybody reading at the same pace from the same books with the same teacher, half the kids being bored, half the kids not being able to keep up, etc. So there's that. And then if we look at healthcare, right, we're talking about healthcare. So there are a lot of really exciting things in personal health and fitness and kind of that category that tends to blend in. I'm a big fan of the healthcare and fitness category. And it's becoming a lot more accessible, right? Lots of sensors, cheap things that people can do, diet, fitness, all these things. Telemedicine is becoming a bigger deal. We are about to start on an M&A project in telemedicine. And with COVID, that's becoming interesting because if you don't have COVID, you shouldn't go to the hospital. If you need to but you need to see a doctor, telemedicine is really the only way. So that's going to become more interesting. And just like business travel, you're not going to see return to the same place. And we can talk about Airbnb in a second. That it was because companies spend a lot of money on business travel, and it's like a nice vacation for a lot of the business development people. I'll tell you a little secret: it's not super productive most of the time, and all these tech conferences for large companies going there, also nonsense, little vacation perk of the job. But now a lot of companies are getting used to doing business via video conference, and they're going to stick with it for a large part. Same thing you see in healthcare, which is nice because somebody is old, sick, for them to go to their doctor is a big deal. And I think that's going to be interesting. So, and then overall trend. So overall trend, as far as looking, it's very difficult to look 2 years, 5 years ahead. 10 years is almost impossible. But right now, if you kind of zoom out and look at tech, every 10 years or so, we have a new tech era. Right. So we had the the personal computing era, right? Late 70s, early 80s. Then we had the internet era, which gave us a whole new way to solve a bunch of old problems, internet connected. Then that gave way to mobile era, right? True mobile era with, well, actually, step back. There's kind of a half era in social media that got started. And then the mobile era hit with the first iPhone in 2007 and put internet in our pocket and really kind of open up the floodgates, and everything was solved again in a mobile way. So we are kind of at the beginnings or halfway through the artificial intelligence era. And this means that AI is going to affect every single industry. It's automation, it's machine learning, it's, this is going to be kind of the new secret sauce. You're going to take that secret sauce and you're going to take the same old dish. That dish might be consumer products and services, business consumer products and services, etc. And you're going to add some of that autonomous or artificial intelligence spice on top, and that will be the companies of the next decade, right? So you're going to see companies that are flourishing with this new artificial intelligence secret sauce. And this is why you see big companies like Google, Microsoft, Facebook, etc., big tech, going heavily after artificial intelligence technology to put it into their own products because they don't want to be disrupted, right? So Facebook is not going to allow the artificial intelligence era of Facebook to eat Facebook, right? Same thing with Apple, Google, Microsoft, etc. So that's the overall trend I see.
Okay, and what is your the special advices for the startups? Because the guys want to do something like the piloting, or maybe go to the fundraising, but online. Maybe you give this advice.
Fundraising is a little tough, right? So at seed stage, what's being invested in, what's being looked at is the team primarily. It's the team. Is this the right team? Do they have the right product? So if I'm a seed investor and I'm looking at these companies at this early stage, I need to get to know them. And this is the go walk around and chat. This is the coffee shop meeting. This is kind of the dating part. You want to get to know them, unless they were recommended by somebody who you already know and really respect. That's probably the biggest challenge. But there are plenty of opportunities. And the important thing for founders is always to look ahead, right? It's going to take you a year to build a prototype. It's going to take you another year to find out if anybody cares about what you built. And if you're going to take it all away, it's likely you're going to be running this company for the next 5 to 8 years. That's the average. And it's probably going to take a decade for this company to go public from today. So if you look at kind of how long that's going to take, you need to understand where your market is going to be in a year, in 2 years, in 5 years, 8 years, 10 years, etc. And you need to set your targets for that, not for where things are today. So don't look at what competitors are doing today, how things are being done today, and try to copy them, because that's not going to get you to develop anything of value, right? Anything that's competitive a few years down the road when you're going to be a real business. So yeah, it's tricky. If you already raised some money, it's probably too late to talk about this now, but I talked about it back in March, what to do when COVID hit. And the important thing was to cut the expenses down to a minimum to be able to get into cockroach mode to survive as long as you can, right? Cockroaches can survive nuclear wars. So that means that, they can certainly survive a economic disaster, whether it takes 3 months, 6 months, a year, or 2 years to get out of it. It looks like we're probably kind of a year-long kind of cycle this time around. So we'll see. By second quarter of next year, maybe we'll be back on track.
Okay, and what is the most profitable and the best strategy for the investors after the post-COVID strategy?
Again, venture capital is not day trading, right? So if we're talking about startups, there were certainly some discounts, like Airbnb, right, was on discount for later stage investors who invest, let's say, a year or 2, maybe 3 years before an IPO. And there were a lot of big deals done that were on discount, and the investors knew that cash is king at that point and put their money to work. When we're talking about early stage venture capital, again, the horizon is 5 to 8 years, depending on the exact stage you're coming in. So you're not going to really change your investment strategy long term unless you were, hospitality investor and all of a sudden hospitality industry got changed completely. Most other industries, they keep doing what they're doing, and this is a speed bump, and they'll get back on track. So I haven't seen many venture capitalists change their strategy overall or completely. The world hasn't really changed long term. So there's certainly some good deals, but it's always important to look at the teams, and this is a bit of a stress test. So that means that you get to see how people react, how they operate under pressure. The last time we had this kind of pressure was 2008, 2009. And that's in tech, that's like a generation ago, right? 10 years is a generation. So a lot of these people have not been tested in this type of environment. And then now you get to see how they manage through this kind of environment.
Okay, and what is the future for the finance and for the wealth management beyond the 15 years, like the next 10 years?
Yeah, I mean, there's certainly, it's hard to explain wealth management and finance to people who are not in it, right? It's a little bit of a paradox. It is very much a profession. It is very much a discipline. It's very much a science to a certain degree. It's not luck. It's not throwing darts. It's none of that. It's becoming a lot easier on the one hand for people to manage their own money, or use robo-advisors like Wealthfront or others. And it's much easier with Robinhood, doing free trades. They were the first ones, I think, to do that, which allows people to kind of gamble and play around. But you really need to understand the financial instruments. And if, you can certainly gamble and use whatever methodology you want for short-term gains, but that's not really investment. When you're talking about wealth management, that's a long-term play. You do asset allocation based on a certain strategy, maybe some of it in equities, some of it in bonds, some of it in real estate, a small portion of it in venture capital, those kind of things. So when somebody is quote unquote wealthy, they will still have professionals that manage their capital. But there are plenty of people playing in the market now. And that's where you see this kind of Robinhood effect on name brand stocks, especially in tech, because young people understand tech. They're getting an extra $600 a week in the US from the government right now, which is about to end. Mm-hmm. And they can't really go anywhere. So they take that money and put it into a Robinhood account and gamble online, essentially. So poker gambling online is not legal in all states, but gambling on stocks is.
What do you think about the travel industry? What is the best strategy for the startups from travel and companies like Airbnb, or Horeca, and restaurants, and the hospitality? What is the best?
Hospitality is the biggest victim as far as industries of this pandemic.
Yeah,
and there's
the
probably
a little bit slow. But what is the strategy for the entrepreneurs?
So all the U.S. airlines got bailout money from the government to not lay off employees, and they committed to not do layoffs before end of September, I believe, is the date. So I think United already announced that they're going to lay off people as of October 1st. So it's a tough market. I mean, all of a sudden you have industry that just got completely decimated. And it was growing steady before that. So you had a lot of these companies feeling really good, buying back their stock with the cash that they had instead of saving it for a rainy day like this and planning for future growth. All of a sudden, that all got taken away from them. Hotel industry as well. Interesting trend I was reading about actually yesterday is that people are taking they're taking vacations within driving distance. So a friend of mine has a house with a bunch of RVs and all sorts of things in the desert in Southern California. And he's telling me about his bookings. It's crazy. So camping has become huge for people, especially in the summer now in the US, let's say at least. You have people going within driving distance, and Airbnb is coming back because people are renting houses. They don't want to be in a dense hotel. They want to be kind of in a separate house. They feel safer that way, where their cleaning procedures are as good, who knows. but they feel safer, and a lot of it is how people perceive things. So that has changed tremendously, and like I mentioned before, business travel is going to take years, many years, to recover to where it was before, if ever, because that is actually training new behavior, right? So let's say you work for a big corporation and you run a team, let's say a corporate venture team, right? You have your, the way you get your budget is you have a total budget. Out of that, you have salaries and bonuses, and then you have a travel budget, marketing budget, etc. The first thing that got pulled from a lot of these for a lot of these companies when they were looking for kind of how to shore up cash is they pull all the non-essentials, and obviously travel wasn't happening anyway, so they pulled it out of the budget. What do you think is going to take for them to put it back into the budget? Especially if they're seeing the performance not dropping, saying, oh, look, you're able to do everything on Zoom. You don't need to go to Barcelona for Mobile World Congress. You don't need to go to Las Vegas for CES, all those things. So business travel, I think, will be affected for a long time. So we'll see what happens. I'll be curious. I got the survey for CES as an example. CES, the Consumer Electronics Show in Las Vegas, that happens every January, early January. Last year or this year, we had about 180,000 or 200,000 people from all over the world. And this was one of the last big shows before the COVID shutdowns. Wow. And they're now doing a survey. The organizers of CES are doing a survey to see what people feel safe doing. So my suspicion is it's going to be a fraction of its size next year if they hold it at all in January. So we'll see how it goes.
Okay. And then the next question about Silicon Valley. What's going on? The really amazing, like the innovation hub. How we can collaborate together. It's not about remote work, but what we should to do, because we should be like keep in touch during the COVID and after it too, and how we can accelerate the acceleration, like the innovation too. If you talk about Silicon Valley as a like a technology hub.
Yeah, well, Silicon Valley is, again, I think we talked about it last time, but a lot of people try to build their own Silicon Valley, quote unquote, which doesn't really work because Silicon Valley has been around since right after World War II. And well, HP was founded before World War II. All right, two Stanford students came out and they got a check from their professor. That professor went on to run the Harvard radio lab during World War II. And he came back to Stanford, became the dean after World War II, and saw how much money, government money, MIT and Harvard were getting, and said that he wants to create MIT of the West. And that's really how Stanford came out of being kind of a boutique university to really becoming a powerhouse and getting a lot of government contracts, creating the Stanford Research Institute, allowing a lot of the research to leave without IP agreements, and they were encouraging PhD students to graduate and create companies out of that. So kind of from the 50s and on, you had a lot of this. Venture capital originally stood for adventure capital, right? Because it was so risky. And US government also had a hand in helping create this industry by adding matching funds. So for every private dollar that was invested, US government would invest two, either as a grant or as a investment in the company. And that's what really created the industry here, more or less. I covered that in my book, kind of first chapter or second chapter of the book is history of Silicon Valley in that sense. So when different regions try to recreate this magic here, it's really difficult because this is a complete ecosystem. You have tens of thousands, if not more, maybe hundreds of thousands of people that have real management experience in tech companies, go from zero to hero, from idea to IPO. And that's something that's very necessary. That's why you see a lot of companies that are growing really quickly around the world. They end up coming, tech companies, they end up coming to Silicon Valley because this is where they need that kind of management talent to grow and need to be close to all the other peers, all the other big platforms in tech. And it's really kind of this concentration here. So how do regions collaborate with Silicon Valley? Well, come here and learn, but then go back and think about what your region is good at, right? So Silicon Valley is particularly good at software, right? Silicon Valley is not known for automotive manufacturing, hasn't done semiconductor for many, many years. All of that is in different parts of the world as far as manufacturing. And on and on and on, right? So Shenzhen, for example, is known for hardware manufacturing. Silicon Valley is not. So you go back to your own region and you figure out what you're good at. So for example, Ukraine, where I was born, Ukraine is particularly strong in software, of course, but also in agrotech. So I'm a big believer in agro business in Ukraine, growing quite a bit, and it has physical assets like all the chernozem, all the topsoil that's really fertile, as an example. And every other region should be looking at what they're really good at, what they really know, what kind of resources they have, what kind of clusters of innovation they can build, and really focus on being the best in the world at whatever they do. So that's really it. That's how I would say, and Silicon Valley has done just fine. I kind of hate to say it during COVID. The entire stock market is being propped up by giant tech companies that are headquartered in Silicon Valley. Most people here can work from home, no problem, that are in the tech world. People that are in the services, that's a different story. But we were the first to shut down in the US. We have much, I think, smarter government here in a lot of ways. San Francisco is a mess, but the state is okay. And yeah, I mean, Bay Area has done just fine through this economically, and doesn't really need everybody's help, but could be learned from in a lot of ways.
Why you focus on artificial intelligence and future of mobility? Why you want to stay in this niche? And what is like the next big thing in these two technologies?
Yeah, I mean, technology. So, how does a technology S-curve work? Is that, certain technology gets developed a lot of times at research level, right, in R&D. And then at a certain point, it becomes mature enough to commercialize into products, right? So what that means is you can take this research and create kind of a generational jump. And a generational jump means that when you're doing true disruption, you're doing something 10 times faster, 10 times better, 10 times cheaper, or you might be opening up a completely new market altogether. So that means that automation is allowing people to do certain things without human touch, which is bad for the economy. A lot of people are going to lose their jobs. By the way, of the people that lost their jobs in America, the estimate is something like 40% will never go back to the same job. And a lot of that, again, is acceleration of the current trend and being driven by automation, where companies have learned really quickly how to operate really at the same level of top line without spending as much money. And they're certainly not going to go back and start spending money again, right, if they're well disciplined. So artificial intelligence is allowing certain things to happen. Obviously, autonomous vehicles, we're a decade away, really, from true autonomous vehicles. Now we have some assistive technologies, let's say. And Cadillac, by the way, is ranked to have the best ADAS system, not Tesla. We will see a lot of these new magical things happen that make our lives easier, make it easier for us to run our business, make it more efficient. And all those things are being driven largely by automation, driven by artificial intelligence algorithms, silicon that NVIDIA, for example, using GPUs. All of that didn't really start until about 2012, when GPUs were started to use for this, for neural nets. So you're going to see really all of that go heavily into finance, insurance, business services, consumer services, physical products, autonomous vehicles, flying things, all that. So that's really the secret sauce of this particular era of technology.
And what is your the favorite cases in these two technologies?
Favorite cases in technology? Well, so I obviously track the transportation mobility sector, as I said, and autonomy is really the holy grail for artificial intelligence in that sector.
Mm-hmm.
I think that's that's coming. We're not there yet. People want us to be there already. Where you're going to see that first is in off-road commercial vehicles. So like mining, you already see there's a lot of tests of fully autonomous vehicles in mining that are
Mm-hmm.
off-road. But you're going to see that eventually in vehicles. I would love to not have to take my kids around to different activities, just have the car take them and bring them back. So that'll be huge one day. In health, Apple Watch, for example, they're doing a great job. I'm running beta right now that they announced. So for example, very timely, Apple created, they can recognize, there's an algorithm that can recognize when you're washing your hands based on your movement, and it'll give you a countdown of 20 seconds, right? So little magic touches like that enrich your life. And we'll see if Apple releases their AR glasses this year or maybe next year. The rumor mill is already starting, and they've been working on them for years. But that will be something magical, right? Because we're all of a sudden we're going to be wearing these glasses, looking at the world, and literally mixing the physical and digital worlds, where we're going to have these physical sensors that can identify objects and
Mm-hmm.
give you this heads-up display. So we're going to become more and more hybrid humans, right? Cyborgs, with the help of this technology. And I think I'm really excited that I think in the next 20 years, we're certainly going to see much more change than the last 50,
Mm-hmm.
right? So think back, to 1970, right? That's 50 years ago. And the state of the world then, the state of technology then, and then fast forward to 2040, is going to be a completely different planet. So I'm pretty excited about that. I think with hopefully President Biden, we're going to have a big renewed focus on the environment, because all of a sudden everybody learned the definition of the word crisis, right? With COVID. Now, when everybody tells them, hey, there's a climate crisis that's not temporary, that's huge, that we need to pay attention to, or this is going to affect our entire species forever, I think people will start to understand that. And from the economic perspective, if you look at all the infrastructure, all the roads, freeways, all of that, that was built mostly after World War II in the US, right, during this period. And that was a big investment into infrastructure in the country. Same thing in Europe. Europe was completely rebuilt. Japan was completely rebuilt after the war. Um, and that created a certain economic kind of step up. I think we can expect something similar. I'm pretty excited about this combination of technology that will make our life easier and more automated in one way, and investment into the next level of infrastructure that's around green technology and the new roads and the new energy sources, and all of that together in the next 20 years creates a really exciting place to be.
Uh, and I have a question about like the investment trends. What do you think about impact investment? And because sometimes people talk like it's look like the new emerging asset class. What do you think? It's look like the something new and something like helpful for the wealth management, for the readability.
I'm not sure if it's
What is look like the because some of our investors and LPs they prefer be the something social.
so there are ESG goals, right? It's the environmental, societal, and governance goals,
More like
and
that.
that's a good checklist. Yeah, there's a good checklist of that's a good lens, right? So again, I was talking to my friend who's a VC in Southeast Asia yesterday about
Mhm.
this, and it'll be coming out on a podcast episode soon. But we're talking a little bit about this ESG, and it's really just a good way to measure a company these days. And it's not just, hey, I want to feel good about investing in this company, is doing the right things. It's actually a good investment because
Yeah, because
society has,
yeah.
yeah, society has moved in the right direction. Whereas before, you could say, oh, impact investment, it's a compromise. It's not going to be as profitable, but I'm going to feel good about that investment. In
Mhm.
reality, is that these investments with a diverse team, with proper governance, and with they're thinking ahead about the environment, that's just a good investment, because long term, the societal perspective on it, as well as doing the right thing, that's the right decision, right? If you're doing a long term investment, if you're day trading, you don't care. But if you're investing for the long term, you want these companies to be good citizens, and really, it's like being on a healthy diet, right? You want to live 20 years longer, you are going to have a healthy lifestyle. So think about it this way: is that you're investing in companies that are healthy in that sense. So
Yeah.
I'm all for it, and I would say that we need to increase pressure on companies to use that as a standard for themselves, all companies. And look at Apple, for example, most valuable company in the world, and they are setting the standard for themselves very high. They said they're going to be carbon neutral with all the crap that they manufacture, right? All the little digital gadgets that get thrown away after a year or recycled. They are going to be carbon neutral in 10 years. So that's a great company. That's the proper goal. It's the right thing to do.
And what is your favorite case because of profits?
Profits? Well, there's an
Like
interesting.
the mix between impact investment and like the hype, like of the profits, and maybe. And what do you think about cannabis industry?
Whenever there's a new
It's not like
market, there's a lot of
sustainable.
hype. Hmm?
Yeah, it's not
There's a
like
lot of hype. Yeah, I mean, it's like cannabis. It's overbought. There's a bunch of companies that are overvalued. They raise a ton of money, but in reality, it's like you're not. People who are thinking that all of a sudden you make it legal, right? In Canada, other places, fully in US, state by state, and all of a sudden this market is going to explode. In reality, what happened is that you got professional farmers coming in, being much more efficient. Um, the market didn't, I don't think the market, I'm not an expert on it at all, but I don't think the market grew that much. But everything got really professionalized, and all of a sudden there's a huge supply, right? Farms that are willing to sell it, and they can produce it cheaper and cheaper, more consistent, and the cost of the product's falling. So it's great for the consumer, but these companies, they have over time, their margins are actually going to shrink because it's such a competitive marketplace, and a lot of these companies are going to go out of business. So I don't think it's a great business to be in. There was a certain time where if you're a first mover, you could take advantage of the hype, but long term, it's not really a growth market, I don't think.
Hmm. If we talk about new business models, what it should be, what is like it should be after the share economy?
So new business models in what business? Well, I can talk. Let's talk about
Yeah,
transportation. Yeah, in my
yeah,
favorite sector. Yeah. So
yeah.
what's interesting is that imagine the world 10, 20 years from now when you have autonomous cars.
Mm-hmm.
Fact is, your car sits in your garage or in your office parking lot for like 99% of the time, unless you're, a taxi driver.
Mm-hmm.
That car takes you to a destination, sits there, etc. So the argument is that you're not going to need, if you can have access to a car anytime, and most people are in cities already do this with Uber. Why would you buy a car, pay for insurance, pay for parking, pay for all those things when it's just sitting there? You don't, if you're not into driving the car, the whole point of the car is to have transportation when you need it. And if you can call a car to take you somewhere, it's easy. So imagine a time when we have fully autonomous vehicles. Something like 70% of the cost of Uber is the driver. And all those prices will fall, and you'll be able to get a ride anywhere for relatively cheap. So this argument, if now economically doesn't make sense for most people to own a car that live in a big city, then certainly, right? So there's that. Then there's this concept of kind of rolling everything together. So Fisker, who are clients of ours, and they've talked about this publicly, so I can mention it. They are pioneering a new model. Well, they didn't start it. Volvo actually was the first one to do it, but basically it's an all-inclusive lease. And that means you put a down payment, you get the car that you want, you pay a monthly payment until you don't want that car anymore, and then you just say, I'm done. And it's not 3 years. In the case of Fisker, it's going to be something like month to month. And what that'll include is pretty much everything. It'll include all the maintenance of the car. It'll include insurance, and it'll include your ability to use that car as your own car. So all of a sudden, you don't have to go out there shopping for insurance. You don't have to do maintenance. With electric vehicles, by the way, maintenance is a lot less of an issue anyway because they don't break down as much. There's a lot fewer moving parts. Um, except in the case of Tesla, they have bumpers that fall off, which is a quality issue. So that's going to change quite a bit. And now you see insurance companies struggling to figure out, okay, so what am I actually insuring here? Who am I insuring? Am I insuring the owner of the vehicle, of the title, and it's an autonomous vehicle? Do I rate the driver because there's no driver anymore? So you're going to see a lot of changes in the insurance industry and kind of the secondary industries that are attached to transportation. And then in ownership models, right? So all you really need is access to a vehicle. At the very most, you're going to need kind of a long, a lease that you're essentially renting a car, and you don't need to own it. Like, you're not going to be able to, the days of being able to take out a wrench and work on your car with your dad, those days are gone. These are computers on wheels, even in the form that they are now. And with electric vehicles, it's going to be even more so. And it's going to be dangerous for you to wrench on your own car and get electric shock. So that's a huge change in that industry in particular.
Yeah, it's great. And last question. What is the best forward-thinking investment strategy for the family offices funds?
Family offices, in my experience, I've found a lot of
actually,
variability.
The advice should be for the alternative investments. If they want to invest in startups.
Yeah, so let's try to break that down, what that means for the audience here, because I don't think everybody here is an investment banker. So alternative investments means alternative to what? Alternative to the traditional investments, which are equities, debt, right? Corporate bonds, real estate, things like that. And usually when you do asset allocation, when you build a portfolio, you say, okay, I'm going to invest, I don't know, 5% into alternatives or 10% into alternatives. Or it's a family office of a guy that sold his tech company for $1 billion, and he really knows tech and he really wants to go overweight tech. And he tells his family office manager, I'm going to invest 20% to venture capital, which would be like big and quite risky, because the industry is, for many other reasons. I'm not going to go into that lecture today. But anyway, so if you're investing in alternatives and you're running this family office, you have to almost think like a corporate investor. So corporate investors, corporate venture sounds like venture capital, but it's very different, because the idea behind corporate venture capital in most cases, probably 80% of the time, is to invest strategically for the goals of the company. So let's say it's a family office that, the family has certain things that they care about, certain things that they're passionate about. That means that their family office should be investing in those passions, in those areas that they care about. And their family office should be not creating a generic portfolio, but they should be looking at asset allocation towards those particular areas that are strategic to their client, to that family. And they need to look ahead, and where do they want to have holdings, right? So on the one hand, it's a very difficult job, because on the one hand, you have to kind of prognosticate and look at where these markets are going to be in a certain period of time, and look at all the research reports and try to be smart in a lot of different sectors. On the other hand, you need to understand your client and understand what their priorities are, and if they look at their portfolio for a review, what they want to see in there, what they're going to be happy about. It's not all about just financial returns, quarter to quarter. For a lot of wealthy families, the important thing is to understand what they're invested in, right? So if somebody cares about the environment, they certainly don't want to buy up a bunch of coal companies, right, in their portfolio, as an extreme example. But if somebody is passionate about any other sector, about health, etc., they're going to want to ask their family office to go out there and invest. In a lot of cases, you see kind of this next generation come in. This, the grandkids come into the family office. They go to business school.
Yeah, like a new generation.
Yeah, they're fortunate and privileged because their parents or grandparents, get them into Harvard or whatever. They pay somebody to take a test for them to get into Wharton. But they graduate school, they're smart, they're educated, they're not necessarily experienced, but they have a better sense of the world than their parents do and where the world is going, and they're going to want to influence the family office where it's investing. So
Yeah, and it could be like something like the opportunistic new startups in new, maybe like you say.
yeah, they're going to get excited about it, but investment in startups is a lot of people kind of use it as a hobby, like angel investing, and that's a good way to lose a lot of money really quickly. But on the other hand, you have a lot of people that look at it and really understand portfolio strategy, right? So, or portfolio theory, which says that you need at least 10 to 20 investments for the math to start working, right? If you just get excited or somebody pitches you and you invest just on a whim into a couple of companies, it's very likely that both of those investments are going to die. But if you think about it and you start structuring your portfolio and trying to figure out, okay, I want a little exposure to this particular sector. I believe in this sector. I did some research on this sector, and I'm picking my pony, or I want to invest alongside. This company has a great founder, and I'm investing a pre-seed, but it's very likely they're going to get their Series A from big name VC that's going to help them get all the way and fight off all the competition. So there's a lot of strategy goes into it. Rich kids going around and doing angel investments, that's kind of dumb money. They might think they're smart, but they don't have any experience. And then you have everybody else that takes this very seriously. Essentially, the best angels are like micro venture funds. They have a strategy. They understand what they're investing in. They're making good choices.
Okay, thank you for your time.
My pleasure.
Thanks
for having me.
Yeah. See you.
All right.
See you. Or maybe like after you travel. Actually, you're going traveling, yeah?
Yeah, I am. I'm going traveling. It's a little bit of a mental health break. Need to go to the beach. Yeah. I'm not saying publicly where, but
no. By the way, we can talk after that about like the new style of the travel, and maybe a little bit more about like the mental health.
It's important to balance things out. I spend at least an hour a day in my home gym.
Wow.
And it's important to me. And even through all this monotony and craziness of sitting there and waking up, going to your desk and working from home and until the sun goes down and then going to bed and doing it the next day for what feels like years now in these last few months, it's important to take care of yourself, because whatever job you're doing, whatever your company working on, it's a project. It's right now. It's maybe for a short period of time or a medium period of time, but who you are, this is actually something really important. This is something that I tell founders. A lot of, especially young founders, have this problem that they focus so much on their startup that their personal identity becomes synonymous with their company. And if you have a bad day with your company, if something goes wrong, if you lose a customer, not get a customer, not get the investment, or whatever it is, all of a sudden you feel personally bad, and that's unhealthy. You need to understand that if you're in a startup game, you are a scientist and you're doing experiments because nobody's ever done this before, and most experiments fail. And you need to be okay with that. And if your experiment fails, doesn't mean that you're stupid or unlucky or whatever it is. It has nothing to do really with you unless you didn't really put in a full effort. So you need to be able to detach your personal identity with the work that you do, and take care of your personal life and all of that. That's very, very important. This is an unfair advantage that young founders have, is that they don't yet have kids, they don't have a mortgage, they don't have responsibilities, so they can put more of their time into their startup. But understand that doesn't last forever, and it shouldn't last forever. If you find yourself in your like mid to late 30s and you're still doing this thing and you're a digital nomad, you need to kind of get a little bit more serious with your life, and make sure that you're not doing something. It's almost like a drug addiction to a certain degree, right? People get addicted and they do this, and then they turn around 10 years later and they're like, oh wow, I'm 40 or 45, and I've done all these conferences, but I have nothing to show for it, right? And then reality starts to hit. If you have kids, kids are expensive. priorities start to shift. So it's really important to take care of your mental health and make sure that you're progressing personally, whether it's your fitness, whether it's constantly learning new things. Keep your work healthy, kind of away from your kind of core, and not do this Gary Vaynerchuk thing where it's like this, this, what he does is like what I call, and some other call, struggle porn.
Yeah.
This guy is worth $200 million, and every time you see him on social media video, he's like angry, and, oh my god, and the worst thing, and oh, you got to do this, guys. It's an act, but it's not healthy. Just
you're right.
Try to be normal. This is that extreme is not for everybody, and most people can't handle that long term. So I'll leave it. That will be my parting word. Stay healthy, my friends.
Yeah, see you. And thank you.
See you later. Bye-bye.
Bye.